Hi, this is James Zhang with Full Capital, and I'm here with Rowan Burch of Rowan Multifamily Advisors. I think I got that right. So thanks for jumping on and taking us through a new deal. I've seen a lot of deals in my time, and this deal has not traded, so I'm excited to learn a little bit more about it. So I appreciate you coming on, Rowan. So maybe give us a little bit of your background and sort of how you got into this business, and then maybe talk a little bit about what you're seeing in the market today.
Yeah, sure, James. Thanks for having me on. Appreciate it. So I'm Rowan Burch. I'm a managing director with RMA. We're a kind of boutique multifamily brokerage shop based here in Dallas. We focus on North Texas. Most of our deals are in the DFW Metroplex and predominantly in the value add space. So I've been in the industry for about 9 years now. I started in 2013, fresh out of school. I worked for a large brokerage firm and then came over and joined the RMA team back in 2016. So I've kind of seen the cycle come through and mature over the last 9 years. It's been a good time to be in Dallas-Fort Worth multifamily. So that's a little bit about me and our firm. And in terms of the marketplace, I think it's going to be another strong year for transactions in DFW. I think what everyone's kind of monitoring is potential rate hikes from the Fed, but I think that'll be kind of a slow and steady process, slow and steady push up. And as long as that happens slowly, I think the market can react accordingly. So I think it'll be another strong year. Fundamentally, Dallas-Fort Worth is still a very attractive market. We still have very strong inward migration. Over 400 people move here every day. And I think fundamentally from rent growth, job growth, lack of affordable housing, all those things are making the multifamily space pretty attractive for investors here. So yeah, it's a little market update.
Well, I appreciate that, and I feel like in the last 9 years, if you bought anything, it essentially did pretty well. So yeah, it's been a great run. But yeah, I mean, just from sort of being on the ground here, I mean, essentially I was touring a property from like 3 o'clock, and then I went to dinner, and I felt like I was in traffic literally from 3 o'clock to 6 o'clock. So I think everything is back in terms, and then those 400 people that you mentioned, yeah, they're all here and they're in their car driving around Dallas
Yeah,
trying to
they're
get
right in
dinner.
front of you, James.
Yeah, they're right
That's
in front
right.
of me. So let's jump into this deal. So Meadows Crossing, 178 units. Let's talk about the location, because I think that's no doubt the biggest thing on this deal.
Yeah, definitely. So Meadows Crossing is it's in far North Dallas or North Dallas. It's right off of I-75 and Meadow Road. So easy ingress, egress. You can get to downtown Dallas quickly. You can get up to the northern suburbs very quickly. And you have 635, which will take you anywhere east and west in the Metroplex. So it's a central location. But in terms of the actual surrounding submarket, the area it's in is called Midtown Park. And yeah, this is a great slide that shows it. So our property, Meadows Crossing, is the blue highlighted property with the orange star. And all the green highlights around it are all new multifamily developments, either that are already constructed or under construction. And so, that signifies about 2,700 units of new multifamily construction in this Midtown Park development area. So a little history on our property itself is it was purchased by a private investor back in the 90s. So they've owned it for about 25 years now, manage the property themselves in-house. And they're really the only older vintage property in the Midtown Park area, which makes it really unique. So location within Midtown Park being the only older vintage property, plus the long-term ownership, I think that makes this a really unique deal that, James and I both know. Most of the deals that have traded or are trading right now trade once, twice, 3 times during the cycle. So this is a unique opportunity from that perspective.
Yeah, and then I think on this slide, one thing to take away is I got it. You've got, average age of construction is 2018, and then rents at these properties. I don't know when you pull this, $1,700 average rents at these properties. It's probably, might be up, 10 or 15% by the time we finish this call. It seems like Class A rents just keep going up. So $1,700, $1,800 average rent. So keep that in mind as you walk through some of these other as we go through the rent comps and sort of where we're projecting rents on this deal. So here's another snapshot, sort of looking south towards
Right.
downtown. Anything you want to add on this piece?
You've got the DART light rail system. The Walnut Hill station is kind of up in the center left of the screen here. It's walking distance from the property. So if there is, people that need to commute to downtown for work or further north and want to use public transportation, it's very easy. There's also some pretty prominent retail centers nearby, Preston Hollow Village being one of them, and then North Park as you move a little further south. So the location is it really does have access to everything you'd want. It's transportation, you're walkable to grocery store, which is just on the other side of 75. There's a Tom Thumb, and then you've got high-end retail a little bit further south. So it's definitely a good solid location.
So this is us right here.
No, sorry, the blue highlights.
Blue highlight is
right
us.
Here.
Got it. All right. Sorry, I'm looking south. I'm not used to that piece,
No,
but
you're
yeah.
good.
So you're looking. So you got Highway 75, which I don't know, probably has 200,000 or 300,000 cars. So getting up
Right.
and down north south, and then you got the DART behind you, and then you've got all these Class A properties surrounding you. Got it. Okay. So I think this goes into it a little bit more, but I mean, you've got the country club, and then you've also got the hospital right to the north of you, I believe. So, okay. So this specific deal, maybe talk about this specific deals and sort of the bones of this deal.
Yeah, definitely. So it is a flat roof chiller boiler property. Couple things that the current owner's done. They're a long-term owner and they manage themselves, but they take good care of the property. They replaced all the siding on the exterior with hardy plank about 4 or 5 years ago. So its exterior is completely hardy, even in breezeways. They did the roofs 2 years ago with brand new TPO roofs, and they replaced the chiller systems last year as well. So from a bones perspective, you do have boiler chiller system, but everything's in really good condition. Property's upkept very well. And we'll get to the interiors in a second, but the interiors is an area where they've just kind of tried to keep up with the market. They haven't upgraded any interiors in any kind of a value add fashion. And we'll get to that in a second, but that's a little bit about the property exterior and bones.
Okay, so pretty much all the units look like this, just sort of your standard, I don't know, Formica countertops, maybe black appliances, a little vinyl flooring, maybe in the wet areas, but essentially outside of that, there hasn't been any upgrades to the countertops or backsplash or things like that. Okay.
Correct.
All right, so they self-manage. They have a laundry facility on property, and then they're rubbing back already. And then they've done new chiller and is it boiler system on the property?
It is boiler system. The boiler is 10 to 15 years old.
Okay, but they changed the roofs out recently. Okay, I got it. And then they manage it. So how many people they have on staff to manage 178 units?
So they're a little overstaffed. It's kind of typical for these a little bit more boutique owner operator kind of companies. So they have 2 inside and 4 maintenance. They really don't contract a whole bunch of stuff out. So I'd say it's probably a little bit on the heavy end in terms of their maintenance staff. I think a normal third-party management group would be able to operate this with 2 in, 2 out.
2 in, 2 out. Okay, I got it. All right. So we saw the rent comps or the Class A comps, and that was like $1,700-$1,800 rents. And then so where are the rents today? And then where do you think you're going to take them, depending on how much you want to upgrade this deal?
Yeah. So this is definitely the important part of this deal. They have not raised rents in 3 years. Before that, it was probably 2 to 3 years before they raised rents previously. So their rents are currently at $700 per unit. It vastly below market, even as the units are, even the shape the units that are in today. So we're 250 below market for the product that we're offering to the residents right now. The 2 relevant comps that really are important here are Lakeside and Central Park. Both of these properties are in the immediate submarket. They're not surrounded by new construction like Meadows Crossing is, but they are in, comparable areas within, a half mile of the property. So we really focused on these two comps, and we said, okay, Lakeside's getting roughly $13.40 rent per month, and Central Park's getting about $11.75 per month. And we took those comps and basically said, okay, we're a chiller boiler system flat roof property. Those are all pitched roof individual AC properties. So we're going to be below them, even if we upgrade the property. So we basically increase these rents to just below Lakeside and Central Park's all-in rents. So even when we, push interior, you upgrade the interior and push the rents, we have $430 worth of rental upside. You're still going to be the cheapest place to live, apartment complex to live in the immediate submarket. So it seems like a lot of push here. I know that 430 on $700 rents is substantial, but it's definitely justified. And even at those new rent numbers, you're still the cheapest place to live in the submarket.
Yeah, I mean, pretty much all throughout DFW, you're seeing, one bedrooms anywhere from 1,000 to 1,200, just depending on the submarket, even on, BC stuff, and then, $1,300-$1,400 rents on two beds throughout the submarket. And so, or sorry, not throughout the submarket, but just throughout DFW. So to be in this sort of location, surrounded by that quality of product, I mean, achievable rents on this deal throughout. So, and then you're still sitting below Lakeside and Central Park. So it's perfect. All right, so obviously that's a huge number, like 900,000 in rental upside. Let's go through sort of how it translates on the income statement versus today's numbers.
Yeah, definitely. So on this slide, if you're reading from your right to left, we have T12 down to a T1. And then on the far left column, you've got our pro forma, which is kind of a year two stabilized pro forma column. So essentially what we did was we just took those rental increases we talked about on the last slide, put those into the top line market rents, put in a kind of a typical economic vacancy for a deal of this age, which is, just over 10%. And so that's the rental income side. The other piece that we looked into was was just continuing other income as is that they're currently collecting. But on top of that, if you look at the covered parking and yard income, we underwrote for 20 fenced patio yards being added to the property for an additional $75 per unit per month. And I think we had about 65 covered parking spaces assumed here at $50 per month. So other than that, I mean, we basically bumped market expenses up to market rates. We have a equal and uniform analysis from Cantrell for our tax value that's in our deal room. So if you have any questions on taxes, you can reach out to those guys. And that's why we were able to underwrite to where we did on our pro forma with 292,000 tax liability year two.
Is there anything on the utilities in terms of water conservation or anything that you guys looked into, or have they done some of that already?
So they've done some of that already. They've been changing out toilets for the last 3 or 4 years. So they did go to a low flow toilet. We have not gotten water conservation group out there for a bid, but that could be something to look into. Other than the toilets, they really haven't done any water conservation. So that could be an additional upside for somebody that's looking to come in and get creative and cut down utility expenses.
Okay. All right. So NOI sort of, let's say on a T3, T12 basis, you're probably around 700,000. And then NOI sort of post year two stabilized, you're about 1.5. So
correct.
Pretty much doubling the NOI on the deal. So here's a pro forma just sort of going out years 1 through 5 or years 1 through 10, sorry. And then, all right. So we've heard about the location. We've heard about it. So how much is it going to cost in terms of purchase price? What are you guys thinking in today's market? What do you think we're going to get to on this deal?
Yeah, so we're whispering around 24 million. I think with this large of a value add deal, we're going to see a pretty wide spread of offers depending on how people are underwriting income. But I think we'll end up somewhere around the $24 million mark. And you could always reach out to me or the rest of our team here for the latest on the pricing guidance and where we think this deal is going to end up.
Okay. Yeah. I mean, with a $800,000 NOI, you're really going to be pretty low leverage on Fannie or Freddie with those low rents. So what we did was we built in just sort of our bridge underwriting here, and we put 2 million. So which is about 10 to 11,000 a door, just depending on what you're going to have to do. Because it seems the exterior and sort of major systems are already upgraded. So depending on what you want to do on the exterior and how many interiors you want to upgrade, we just built in 2 million. We're usually getting 100% of the rehab in these bridge loans. So just depending on your structure, most of the deals right now are probably in this 75% of purchase range. And so I would look to maybe 375, 4% over SOFR on these deals. And it's really just going to be dependent on your experience of sort of turning around properties of this size. And, but looking at sort of a stabilized debt yield of about 725 by year 3 is what most of these bridge lenders are looking to. So, so appreciate you coming on, Rowan. Do you have a call for offers date on this deal yet, or are you still doing tours right now?
We're doing tours right now. We do have a call for offer date. We have not sent it out quite yet, but it's going to be March 22nd, which is a Tuesday.
Okay. All right. Perfect. Well, I appreciate you coming on. And if anyone has any questions or wants to set up a tour, you've got a couple weeks now to get with these guys and go out, tour an asset with $400 rental upside. So I appreciate you
That's right.
coming on, Rowan. And any final words on this deal before we jump?
No, I'm good. Thanks for having me, James. I think this is definitely a unique deal. It's not the same deals you're seeing, day in and day out. So come by, take a look. Happy to walk you through it. And yeah, looking forward to talking with y'all.
All right. Thanks a lot, Rowan.
Thanks, James.